Tuesday, May 19th, 2020, Maneco 64, home of alternative economics and contrarian views. Today I want to talk about inflation, how the only way to protect your savings from inflation is through gold and silver as well, but I will focus on gold. There's been a lot of talk these days by central bankers like Jay Powell or Andrew Bailey from the Bank of England. What they're saying is that yes, there's a debt problem right now, that they're printing money to monetize that debt, but that it will be sorted out when the economies get back to normal. The debt will be able to be paid off, or as Powell also said, the economy will grow faster than the debt grows, and that will make the value of the debt decrease. Well, that's euphemism for inflation. And that's what happens in a fiat money system. As Alan Greenspan said, in the absence of a gold standard, there is no way to protect savings from confiscation through inflation. And yes, they are fooling the public, saying that there's a danger of deflation. Inflation, as we know from the classical definition, is the excess creation of money and credit resulting in a general rise in the price level, a consistent general rise in the price level, or even persistent if you want to call it that. So that's how they're going to do it, folks. They're going to keep creating more and more debt, more and more money. So the dollar or the pound that you have today will only buy a fraction of what it can buy today in about 5-10 years time. And in maybe 50-80 years, it's going to buy nothing. And that's what I want to talk about today. Yes, 80 years seems like a long time for us mere mortals, but there are a lot of families out there who have huge generational wealth, and they don't think in terms of 20-30 years. They think in terms of 100 years, maybe even more. And I'm going to go through the German government international 5.5% loan made in 1930. Here you go. I've got 3 of them. I got it on eBay the other day, and I thought it'd be interesting to buy it, to look at these bonds. These are bearer bonds. I'll go through the history of these first. They came out of the Young Plan. As some of you know, after World War I, Germany was lumbered with a lot of reparations. They had a lot of debt, and they had a lot of difficulty paying that off. So in 1929, Owen Young, who was the CEO of General Electric, was in charge of doing a deal with Germany and the Allies to kind of restructure the German debt. I'm not going to go through the whole thing. I'll put the Young Plan in the description, a link for it. You can read about it. But basically, one of the results was that the German government issued these bonds. It says it's 100 million in the Wikipedia and all the other stories, but if you actually look at the prospectus, which I did, read the whole thing, you'll see that it wasn't exactly 100 million. It says German government international 5.5% loan 1930. So they've got it in English, German, and French. We'll read the English, of course. It says 5.5% gold bonds. So there you go. There are gold bonds. Total issue in the United States of America, 98,250,000. So there you go. It was 98,250,000. Maybe Germany did borrow 100 million. Maybe the bankers took the 1.75 million as fees. Who knows? But this is what it says, because this is a 35-year bond, because it matures in 1965, issued in 1930, right? Not a bad interest, 5.5. So let's go through it quickly. The German Reich, hereinafter termed the obliger, for value received, hereby promises to pay on the first day of June 1965 to the bearer of this bond the principal sum of $1,000. So this whoever had this didn't get it right because it's still here. And to pay semi-annually on the first day of June and the first day of December in each year until such principal sum shall have been paid, interest thereon at the rate of 5.5% per annum in accordance with the coupons for such interest hereto attached upon presentation and surrender of such coupons as severally they become payable. Such principal sum and such interest will be paid in the city of New York, State of New York, United States of America, at the office of J.P. Morgan and Co. in the borough of Manhattan, in the said city of New York, in gold coin of the United States of America, of the standard weight and fineness existing on June 1st, 1930. So I'll stop at that. So it just goes to show you how the bankers, you can't trust them. This is not worth the paper it's printed on anymore. You can't get your $1,000 in gold at $20.67 an ounce. You can't even get anything for it, for these bearer bonds. And the interesting thing, you look at, these are the coupons here. And whoever had these was able to get some interest because they clipped the coupons up until May 1945, as you can see here. Why May 1945? Well, probably because that's when Germany, the German Reich fell. Investors in these bearer bonds got screwed completely. And the best thing is not to deal with J.P. Morgan, as you can see here. I think it was not just J.P. Morgan that dealt with this bond. It says here, countersigned. See, there's the bond. It was countersigned by the First National Bank of the City of New York. So that's the old Citibank, I think. So it was a consortium of banks that arranged this loan. But yeah, you had to go and pick up your coupon from New York. And I think, for example, there's stories about how J.P. Morgan Paris stayed open during the war. So now you know why J.P. Morgan Paris was opened during World War II. Probably some French investors took their coupons to J.P. Morgan in Paris and got their gold coin. I think that's what it was, because this bond was not only written in English, but French and German, as you can see here. So I thought that was really interesting to actually look at the bond itself and read about it, and not just read about what we're told in the books and Wikipedia. But I'll go over another article here I found from a long time ago in the New York Times about these bonds and other bonds. It's from January 6, 1995. Marketplace, Hitler defaulted, but now Germany will pay debt. So what does this say here? Sometimes a bad debt turns good. You just have to wait half a century. Between the two world wars, American investors lent Germany the huge sum of $210 million as part of the first great international effort to bail out a bankrupt country. I would argue it's worth even more in terms of gold, that 210 million. But let's keep going. A few years later, Hitler came to power and defaulted on the loans. Now the German government is taking steps to pay the last of the money owed. One thing I would say, it wasn't only Germany that defaulted on loans. Hitler came to power in 1933. The UK defaulted on loans in 1931. And you might ask, oh, I never heard of that. Well, how did they do that? Well, because loads of other countries were holding sterling debt from the UK government, paper. They were holding paper in sterling. And at the time, before 1931, this country had gone back on the gold standard, I think in around 1925-26. So in 1931, the UK actually defaulted on those loans because they said we won't pay in gold anymore. So it's not just the Germans that defaulted. So let's go to the section in this article where they talk about these bonds here and the Owen Young plan, because prior to the Owen Young plan, there had been a lot of restructurings in the 20s of this German debt. It says the Dawes plan was widely hailed as solving the problem, but by 1929, Germany was in trouble again. So the Dawes plan was the one before the Owen Young plan, resulting in a new conference headed by Owen D. Young, the chairman of General Electric. A new international bond issue was agreed to, with the Americans putting up $100 million when the bonds were sold in 1930. So there you go. That's that issue. That was widely and wrongly viewed as solving Germany's financial problems once and for all. And there was talk of Young becoming a presidential candidate. Some of the details of the Young plan were settled in private conference between a German official, Hjalmar Horace Greeley Schacht. He became Hitler's banker, this guy. His father had lived in New York and admired Greeley. And David Sarnoff, soon to become the president of the Radio Corporation of America. Their common language was Hebrew, in which Schacht had a doctorate. In fact, the Young bonds, which paid 5.5%, there you go, these are the Young bonds, were destined to pay interest for only a few years. European holders of the bonds got a few more interest payments than the Americans, which the Germans justified by saying they were running trade surpluses with Britain and France, and thus could come up with the needed foreign exchange. I bought this on eBay from someone in Germany, so maybe this is one of the European holders who were able to get the coupons up until May 1945. The other thing, interesting thing about the Owen Young plan was that it created the Bank for International Settlements. And if you read the prospectus like I did, the trustee for these bonds was the Bank for International Settlements. So I think probably some very wealthy Europeans got their coupon up until May 1945, because the BIS was still in business. And you had German representatives, and you had British and French and Italian and Japanese representatives at the BIS all throughout World War II. So now to the interesting part about how inflation really confiscated the wealth of the people who put their money in this bond, because this debt was paid back in 2010. That was the deal. I won't go through it. It's going to take too long. But basically, part of the deal in the 50s, I think, was that it said that when Germany reunified, that all this debt would be paid off. I think West Germany paid a lot of it off in 1980. But the last of this debt, or this bond, was paid off to American investors in 2010, which was 15 years basically after this article, and 80 years after the original bond issue in 1930. Investors finally got their money back. But do you think they actually got their money back worth in gold? No. It was very easy for the Germans to pay that back in 2010, because in 2010 the dollar wasn't anymore what it was in 1930. Even the US government had defaulted on the dollar itself by taking the US off the gold standard in 1933 and then revaluing the price of gold. But first, let's have a look at the whole issuance. So it was 98,250,000 loan in 1930. And that $20.67 an ounce, because that's what a troy ounce of gold was, it equaled to 4,753,256.6 troy ounces of gold. In 2010, the loan would be worth $5.7 billion. And for the price of gold in 2010, it varied from like 1150 to 1400. So I took an average of 1200 to make it simpler, but it gives you an idea how without gold you can't protect yourself, because what they should have gotten really, the investors, was the equivalent of 5.7 billion. So for someone who bought one of these bearer bonds for $1,000 in gold bonds, so $1,000 in 1930 was 48.789 troy ounces of gold. In 2010, that should have been $58,546.8 dollars, but they only got 1,000. So it just goes to show you that without gold, you cannot protect yourself against inflation. And throughout this period, 1930 to 2010, a good part of this period, the world was on some kind of gold standard or gold exchange system up until 1971. It was only in the last 39 years of that period that we went totally unanchored. But it just goes to show you how gold is important generationally, and even I think in people's lifetimes. So that's why you need to have it. I know yesterday the markets were all over the place, but that's what happens on a daily basis. Markets are volatile, but in the long term, that's what you need to focus on. So let's finish off looking at the markets this morning. It's 8:23 a.m. London. Gold yesterday, of course, made a new all-time high for the year. I think it was around 1765. And then typically, as the US came in, we saw gold go down, silver go back down. Silver did really well as well. I think it went up to 1765, the spot. Why did it do that? Well, a little bit of probably manipulation, a little bit of speculative froth. And the other point I would make, yes, markets don't go up in a straight line. I still think we're going to see $2,000 gold very soon. And if you look at the gold chart, the previous leg up from March in gold from 1450 to 1750, you had a lot of ups and downs. So this is what we're seeing, in my opinion. So right now, gold is at 1730. It's down about $2.50. The range has been 1725 to 1741. Spot silver is right around $17. It's up 3 cents. The Dow has continued to go up. It's 150 points higher or 0.6%. The Dow futures at 24,722. Yeah, I saw there's talk of a new vaccine test. I mean, there's so much information out there about vaccines. As they say, and I think this is kind of a psychological war that we are experiencing, this crisis. The first victim of war, as the old saying goes, is the truth. So I think the markets are very susceptible to all these rumors, all this talk of, how can I say, cures. A few weeks ago, it was Gilead's treatment, and the market went up, and then we went back down. So I'm not sure how long this will last. We're seeing the currencies as well being boosted. Since yesterday, the pound and the euro are still rallying today. The pound is at 122.57. It's up another 0.5%. The price of gold in pounds went up to like 1460 almost, and now we're back down to like 1412. But if you look at the dealers here in the UK, one of them, Atkinson's Bullions and Coins, and they're very good. I've dealt with them before. Their website says, due to the current situation, we are unable to take your order. So they can't even take your order. And then you go to Gold Investments. I have a promo code with Gold Investments. They're still dealing. But if you look at the prices, the premiums are massive. The Krugerrand, for example, was priced at almost £1,500 to buy, with the price at 1411. 1 ounce Britannias are at 1566.91. In the physical world, gold is a lot more expensive. And why would I also not sell it here? Well, because the dealers are not giving you a really good price, in my opinion. And why is that? Well, because the dealers use the bullion banks. They use the unallocated market to hedge their exposure, and this market is fraudulent. It's a paper market. The premiums should come down as the market continues to rise, in my opinion. Just to finish off with the bond market, the 10-year yield is down 2 basis points at 72 basis points. So yeah, yields did go back up yesterday. I guess it's difficult not for yields to go up when the Dow is up like 1,000 points. But yeah, don't hold any bonds, especially the longer term bonds. Don't be fooled. They're going to do the same thing in the next 10, 15, 20 years. They're going to inflate away all this debt that they're creating. We're up to 25 trillion and counting in the US national debt. We're going to be at over 43 trillion probably in 2024. And the only way to carry this debt is to default versus gold, to reset the gold price. They could try to default, like stop paying it, but that wouldn't be politically palatable. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. You can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.